Okay, this is part 13 of why what Senator Mitch McConnell said is wrong. He says, we don't have a taxing power. We don't tax too little, that's false. And did I say this was part 13? Okay, I'm going to pick up where I left off, and we're talking about the four augmentations of income of corporate executives. And there's a fifth. You see this chart right here? It says dividends rise as tax rates falls. Did you get that? By the way, this chart is by the source is the IRS. And it's for this period right here of 1990 to 2008. That's here, the period that we're talking about right here. We're talking about the fifth augmentation of income of executives. There's a line right here on this chart. It marks where there's a spike here of dividend payouts. And the date is 2003, when Bush lowered the tax on capital on dividends from 35 down here to 15. So that's how the Congress rigged the tax code to benefit the wealthy, because they're funding their political campaigns. I want to go next to this chart right here. It's the history of tax rates. You see this line here on the bottom? Well, that's this dotted line right here going across here. It's the capital gains tax. 25% here, long term. It goes up here to 39.875 to pay for the Vietnam War. Then it goes down here. You can see right here where it drops down here. Carter reduces the capital gains tax to 28%. The war is over. It goes down here some more. Reagan reduces it from 28 to 20. Then it goes back up over here to 28. And then the Republicans here, when they control Congress, they reduce it again back to 20. And you see it goes down here some more. George Bush reduces it from 20 to 15. Now this top line here, it is a broken and a solid line, and it represents two types of income: dividends and ordinary income or wages. Now, I want to talk about this line. The reason why I'm going here is because I said in one of my previous videos that prior to Bush, dividends are always taxed as ordinary income. 39.6, 31, 28, 50, 70, 91, 94. Well, I went back too far. Made a mistake. It stops here at 91. That's 1954. Now this chart is from 1954 to 2011. From 1954 here. Okay. And this top line right here is equivalent to this one right here. Now dividends here, well, first of all, before we start there, let me explain what happened prior to 1954, because I went back too far here. there were periods prior to this. The dividends were taxed and not taxed. From 1913 to 1936, the dividends were exempt from taxation because income was taxed in, there was a tax on corporate profits that was considered double taxation. From 1936 to 1940, dividends were taxed as ordinary income. From 1940 to 1954, again, dividends were exempt from taxation. And the probable reason for that is that there was a high tax on corporate profits here of 40% from 1942 to 45. On top of that, there was a excess profit tax. It was increased from 90 to 95% in 1943. And corporations paid dividends and Liberty bonds to fund World War II. Well, the Internal Revenue Code was changed here in 1954. Now this top line right here shows that dividends and capital gains were taxed the same at 91%, the top rate. There was two exceptions. The first $50 of dividends was excluded, and there was a tax credit equal to 4% of dividends. Otherwise, dividends were taxed the same as wages. Now you can see on this chart here, it drops down here. Well, here's where it is, 91 down to 70. Well, it leaves out this surtax here to pay for the Vietnam War. But this chart right here shows that wages and dividends were taxed the same here. That's incorrect. Did I tell you that this graph here is by the source of the Tax Foundation? The Tax Reform Act of 1969 taxed unearned income, which includes dividends and interest, at 70%. But the maximum tax on wages was lowered to 50. See this wavy line? Well, this chart here doesn't show that separation. Now it does show the drop from 70 here down to 50. See right here? Now, dividends and wages are taxed the same equally. Now there's another change in the tax code. It's called the Interest and Dividend Compliance Act of 1983. That would be right here. That repealed the exclusion on dividends and the 4% tax credit. Now, dividends and wages are taxed the same at 50%, 38.50, 28, 31, 39.6, until we get over here to Bush. You see the solid line here and the broken line, they separate. This is where Bush lowered the tax on dividends from 35 to 15 and kept the top tax on wages up here at 35. Earned income. Now here's the thing. In the 1970s here, unearned income, which includes dividends, was taxed higher than earned income or wages. But we get down here to Reagan, he changed it. Now they're both taxed the same, at 28. But we get over here to Bush, he turns the tax code upside down. Now wages, earned income is taxed higher than unearned dividends. Now his reason for doing that, or argument, was that they were double taxed. Now this is 50% at least a valid argument. However, there are many forms of double taxation. Some states tax income as well as the federal government. The same with the corporate tax and the estate tax. But because they're two different entities, shareholders and corporations are two different entities also. But the form of the tax cut on dividends by George Bush is not correct. And here's why. Some corporations that pay dividends pay little or no tax on profits. I can give you one example. General Electric, which has paid quarterly dividends for 100 years. But in the last 10 years, their average effective tax rate was 1.8. 1.8 in 15 is 16.8. There's a big gap there between the amount they're taxing dividends and wages. The federal government or Uncle Stan is being shortchanged on profit because he contributes, the nation contributes to profits, corporate profits. Now there's another reason why the Bush tax cuts on dividends are not correct. If you're in the 25, the 28, or the 33, or the 35% tax brackets, it's a flat tax. Whether you have income of 100,000 or 10 million. That's not a fair tax. Dividends is a form of income, and it should be taxed subject to the graduated income tax. Now, I'll give you the correct form of a dividend tax if you want to give credit to what corporations pay on profits. That would be a 10 to 40% exclusion based on what corporations pay, and the remainder subject to the graduated income tax. Or dividends taxed as ordinary income, and you get a tax credit of how much the corporation paid on the dividends that you receive. Now that's fair. But by no means should there have been a reduction of the dividend tax here when you have these high deficits, when you're involved in 2 wars, and the income tax rate is cut in half. Now, I want to go to this chart over here. This is data. This is for the year 2008. Now, George Bush is president, and it's by Emmanuel Zayas, the University of California at Berkeley. He's an economics professor there. And it says average income per family distributed by income group. Now these discs here represent income groups. Now, let me see here. One reason why I want to go here is because I want to compare the income tax rates in 1936 under Franklin D. Roosevelt. And the time is up?
Yeah.